Hi, my name is George Dagnino. I'm the editor and publisher of the Peter Duck Portfolio. There have been a lot of people pretty smart, much smarter than I am, saying that there's going to be a recession, there is going to be for the last more than 12 months, and obviously it did not come. The problem with being wrong, of course, about the economy is that you invest in the wrong assets. I find, and as I showed in my previous videos, if you read the market right in the right way, very simply, they tell you what to do. They tell you what is happening. So the purpose of this video, again, to make an update to previous videos on how I read the markets and what they are telling us. So far, it looks like they've been telling us and giving us the right message. Let's see. Of course, in order to read the markets in the correct way, you have to have a framework. My framework is the business cycle and how it relates to the stock market. The business cycle, very simply, let's say here, phase one and phase two, tell you that the economy is growing. The economy is growing because business is, manufacturing is improving. To improve manufacturing, they have to buy raw materials, they have to borrow money, they have to hire people. So you see upward pressure on interest rates, commodities, and employment. So there is a point, though, that when around here towards the phase two, where inflation starts rising, interest rates start rising, people start making less money because of inflation, and demand slows down in real terms. Manufacturing keeps on producing. At some point, they see they have too much inventories. There is an OMG moment where they find out that they're losing a ton of money because they have too much inventories. So they cut production, they cut borrowing, they cut people, they cut buying raw materials, commodities, wages, and interest rates start declining. You have the slowdown in phase four until the whole inventory sales are back in balance, and then the business cycle start moving again. Now, why do we care? And this is very important. I showed it in all my videos, and I hope I can convince you because in phase one and two, where do you invest? Obviously, you invest in stocks that are profiting from companies that growing and growing rapidly. So that's where you want to invest in growth. In phase three and four, instead there is a slowdown. So the investment strategy is more towards defensive stocks, which are utility, healthcare, and staples. In phase one and two, you buy growth, you buy financial, you buy industrials, you buy commodity sensitive stocks. So this is the framework. Now, let's see now what is the market telling us using my approach and see if this has been correct or not. I found out that I can follow the business cycle in real time using market data. So this chart shows the business cycle that I showed you before as printed, as I print every second from market data. And as you can see here, the economy has strengthened, then has weakened, and this has strengthened again. So I'm not going to go through the analysis of showing, because I've shown this before, that strong sector are outperforming. Again, we are interested in outperformance. This is the bottom line. Why this is very important concept. You want to buy sectors and stocks that outperform the S&P 500. They have two big advantages. One, obviously, that they outperform the market. But the second major advantage that I found is that when the market has a small correction in a bull market, the strong stocks or sectors decline not as much. So they have a defensive nature in a way in a bull market. Now, when the market slows down, when the business cycle slows down, then instead the sectors that outperform are the defensive sectors. Now, and I have videos, by the way, showing this curve in beginning here in 2020, mid 2022, that started to turn down up. And then that's when everybody was waiting for recession, this curve was saying, no, George, just you got to look. There is an expansion going. So the strategy should be not defensive, but instead stocks that outperform in a growing economy, not in a weakening economy. So what I'm going to do now is show you what has really happened and what is happening right now with the precise message of the market. This is a typical chart that I use to do my work. And you will see in the top panel and lower panel. In the top panel is the price of the ETF, in this particular case, VUG, which is the growth ETF. The bottom line, again, don't confuse now, this is the relative strength of VUG. By relative strength, I mean the ratio between VUG and the S&P 500. So if the relative strength is rising, means that VUG is stronger than the market. So if you buy VUG, you outperform the market. This is where you want to be. So the price is rising and the relative strength is rising. This is what you want to see in your investments. Now, in this particular case, the fact that VUG is rising in prices, not only that, but the relative strength is also rising, is telling you that VUG is outperforming the market, and tells you another thing, that VUG is growth. In other words, the market has preference for growth stocks. It's not looking at defensive stocks. So the market is believing, it has been believing, because look out, for a long time this has been going up, has been believing in the bullish story, in the fact that the economy was stronger than generally expected. And this is where you want to be. So let's see now other cases. This is a similar chart as before. In the top panel, there is the price, and the bottom panel is the relative strength. Now, in a stronger economy, what you want to see is commodity rising, because in phase 1 and 2, manufacturing is strengthening and business needs raw materials. And of course, energy being the primary raw materials required by manufacturing, by business. And what you see here is that XLE, which is the ETF for energy, has been growing in prices, which is fine. But is it growing enough to attract, to be interesting as an investment? And the answer is yes, because as you can see here, the relative strength has been rising. So what you have is price rising and relative strength is rising. So what this sector is telling you, what investors are telling you, that they are buying commodities like energy because they believe the economy is strong and requires energy. And this is very important. So you see what kind of picture now is shaping up. Let's see other examples. Again, same chart. The top is the price. The bottom graph is the relative strength. That is the ratio between the price and the S&P 500. And of course, if you have a stronger economy, you should not be surprised that industrial stocks are strong. Not only their price is strengthening, but is also the relative strength is turning up. So that investors is telling you this is where the growth is, and this is where money can be made. So you're already beginning to see the kind of things that you see in phase 1 and 2 of the business cycle, as shown also by our indicator, that investors are preferring industrial stocks, are preferring stocks that use commodities like energy. So this looks like the market is beginning, you see, it's shaping up. Look, don't think about recession, think about expansion. That's what investors are saying. That's what the market is saying. So now let's drill down to the practical investment. Again, by the way, this is not investment recommendations. Absolutely. This is a way of showing a kind of analysis to invest in winning stocks. That's really what I'm driving at. Now, in the same chart, top is the price, and at the bottom is the relative strength. Now, Caterpillar is an industrial stock. So the way I do it is not that sophisticated. If you go into the industrial stock, you take the best, the largest companies, and you see which companies, which stock prices are outperforming the market. So you are not only in a sector that is outperforming the S&P 500, but now you are in a stock that is outperforming the index. So you are really in a winning position. Now, in this particular case, Caterpillar has been rising because the industrials have been rising, and you can see the relative strength is also rising. So you have the combination of two things: prices rising and relative strength rising. So this is an excellent thing. By the way, I made this comment in another video. The reason the relative strength is important because it tells you what very large investors like mutual funds and private equity funds are doing. They have knowledge that you and I will never have, no matter how smart I or everybody else sounds. They have inside knowledge of what the company is going to do because they have contact with the executive management. So when you see the relative strength, in this case, declining, it means something is wrong. Something is happening either from an economic viewpoint or something in the company. And these people are selling before usually the price starts declining. So it's an important, the way I analyze stocks, I always look at the relative strength. If the relative strength is like Caterpillar going up, that's okay. It's a good company. You're likely to make money in a stronger economy. But if you see the relative strength coming down, then means that something is wrong. Let me give you an example, another example. Same chart, the price is at top, and the relative strength measured as the price divided by the S&P 500 at the bottom panel. Now, this is staples. You should not expect, and they rarely are strong, in a stronger economy. In a stronger economy, staples are weak, and this is what's happening. Yes, the price is rising. That is fine, but look at the relative strength. The relative strength is down, so they heavily underperforming the market, and that's what happens when the economy is strong. So in a way, what the weakness of the staples confirm the strength of the industrials, because you never have a strong staple and strong industrials at the same time. Because the economy is strong, then people invest in industrial. If the economy is weakening, people are beginning to prefer staples. So the weakness of the staples confirms that the economy, the message of the market, the economy is strong. Or let's put it in a different way, is strengthening. Yes, Coca-Cola is a great company. However, what this chart is showing, that the price of Coke can be, the stock can go up, but is underperforming the market big time because, again, it's part of the staples sector. And the staples sector do not, like McDonald's, they do not perform well when the business cycle is in phase 1 and 2. So this is also very important. What we are seeing is that the stocks that you expect, the sectors that you expect to underperform in a strong cycle are actually underperforming, confirming that the economy is strengthening. And this is another way of putting the graphs of the 11 sectors of the S&P 500 since the beginning of the year. You have the cyclical sectors, the sectors that you expect to perform well in a growing economy do actually have performed well, and the sectors that have been underperforming poorly in a strong economy are actually performing poorly. So what about the stock market itself? What can we expect? Now it looks like we are in a strengthening economy. We are in phase 1 and 2. What about the stock market? Well, in phase 1 and 2, what you see is, and I showed in other videos, interest rates rising, and if you look at the 2-year treasuries, they're actually going up. So you are in the phase that interest rates rising. So we are somewhere in here. So the more interest rates rise, the closer you will get to a peak in the stock market. So we are somewhere in the middle where the blue line is saying, with interest rates rising, probably inflation rising because of strengthening economy, and at some point the stock market will sort of pause and possibly decline. But as always, we will listen to what the market is telling us rather than make forecasting, I guess. So what is the message of the market? Well, the market is, if you want to outperform the S&P 500, you better be in cyclical sectors like industrials, possibly financials, energy, commodity-based cyclical sectors. Then within the cyclical sectors, buy stocks that outperform the index, and then you will be in great shape. Obviously, the market confirms with the weakness of utilities, the underperformance, not weakness, the underperformance of utilities and staples, that really investors are really driven to the growth aspect of the economy and of the stock market. Again, if you go to our surveys in the Peter Dack portfolio, I have plenty of stocks suggesting that are doing actually think pretty well in this environment. I want to thank you very, very much for following this video. Please do subscribe to this channel. It helps me tremendously. And I hope to see you really, really soon. By the way, the advantage of subscribing to the channel is that when I publish another video, which I basically do it every week at least, about what is the message of the market, you will receive instantly, the advice to review my videos. Again, thank you very much for following me. Take care. Have a wonderful day. So long.